Views expressed are solely those of the speakers and do not represent this show or its team.
I think that it's fair to say that there has been a structural shift in the way that we ought to think about the economy globally. We've seen a shift to tariffs that changed the nature of trade. We saw COVID, which highlighted our interdependencies. We saw a renewed bout of tariffs when Trump came back into office, and now with the Iran war, we're seeing how the interdependencies in the global economy really expose weaknesses for individual countries.
Welcome to Built to Last, conversations on wealth, work, and life, where we focus on building businesses, wealth, and legacies that last. I'm Wade Lopez, and over the last 3 decades, I've been working with business owners, entrepreneurs, and families navigating how to build, grow, and ultimately transition what they've created. Today's conversation is about a structural shift in the global economy. And while most investors are still making decisions based on how things used to work, not how things are working today. Because if you're a business owner or an investor, this directly impacts how you create capital, manage risk, and think about the long-term outcomes. To help me break this down, we have our regular with us, Gary Aiken, our Chief Investment Officer, who focuses on markets, portfolio strategy, and transitioning what's happening in the economy into real-world decisions. Gary, welcome.
Great to be here, Wade.
Well, let's jump right into it, Gary. And I want to talk about, the big question is, are we in a cycle right now, or are we in a structural shift?
I think that it's fair to say that there has been a structural shift in the way that we ought to think about the economy globally. And, when I think about, where we were in 2016, maybe the pinnacle of globalism, to where we are today, we've seen a shift to tariffs that changed the nature of trade. We saw COVID, which highlighted our interdependencies. We saw a renewed bout of tariffs when Trump came back into office, and now with the Iran war, we're seeing how the interdependencies in the global economy really expose weaknesses for individual countries. And so I think there will be a structural shift in the way people think about this stuff.
Do you think that's going to be a temporary, or is this how the system is going to function moving forward?
I hope that it would only be temporary. But I think the reality is that once you have broken trust a little bit, then people start to move in opposite directions. And so we've hugely benefited from global trade and the ability to outsource things that don't make sense for us to produce locally, and to produce locally when it makes sense for us to export. And trade and economics have become much better over time because of that. But when your trading partners decide to do something that turns that system on its head, you say, well, I just can't deal with that. I mean,
right.
For example, Australia doesn't produce any gasoline. It imports virtually 100% of its gasoline from China. Well, China has decided that it wants to stop exporting gasoline because it doesn't know if it will be able to get all the petroleum it needs to generate gasoline for itself.
Right.
So now Australia has no gasoline.
Right.
If you were an Australian politician, you would probably hear from your constituents that is unsustainable. Then the problem with that is that it's going to take 5 to 10 years to build back capacity that was abandoned.
And I think that discussion goes from efficiency to resilience, right? I mean, that everybody's got to make that adjustment. But my question is really, what's actually changed in all of this in your mind?
I'm not sure what has actually changed. What we need to think about as investors is, if this structural change exists,
right,
then what are the places that are likely to benefit from it? Which sectors are likely to benefit? Which companies are likely to benefit? And which ones are likely to get hurt from it? And we need to really be thinking about that in a global context.
Right. So are we saying this is cyclical, or is this it's more of a shift in how the system is built, or it's going to be built in the future? I mean, I think we're seeing a lot of change there.
Yeah, my guess is that it will be gradual shifts
Right.
in the direction of onshoring and friendshoring, and reducing the exposure
Okay.
of having all of something that you get from not being able to get that. But at the same time, the benefits of trade, once this war is ended, once we can get back to freely trading with each other, those benefits compound significantly. And so I don't think the world is going to stop trading with each other. We're not going to go back to mercantilism, but we're not going to go exactly back to pure globalism the way we had it before.
Well, we're starting to see some of that move. We'll talk into about the dollar again. But one area I don't think people fully appreciate or weren't appreciating is energy, right? And I think it matters. I think it matters a lot. So explain to us why it does matter and what you see coming when it comes to energy.
Energy investment is going to be an important thing. And, we have seen our energy exposure and portfolios go up over time. And, recently we added to our energy exposure across client portfolios.
Right.
And I think the reality is that, one, with the war in Iran, even if the war ended today, it would probably take 2 to 3 months to wash out the backlog, and then probably another maybe 3 years to get all the capacity that's been lost back online.
Right.
So from that standpoint, we think that the price of oil is probably sustainably higher from here. And that goes for the price of natural gas liquids and probably for the price of energy derivatives like fertilizer products. And, one of the things that's really important for investors like us is to keep on top of all these things because every day, just like during COVID, when we found out, what happened when, we couldn't get lumber from Canada anymore or something like that.
All right.
Yep. We find out that these interdependencies exist, and they exist for good reason because there are benefits from specialization.
Yep.
But every day we find out something else that was a bottleneck or a dependency that is just going to take time to resolve. So what do you see elsewhere? You see that the countries that are net energy exporters are in a much better position. The United States is in a great position. Mexico is in a great position. Canada should be in a great position. Norway is in a great position. Everybody else who's importing energy is in a tough situation right now.
Explain to people why they should care about that, especially if you live here in the U.S.
Oil is still a global market.
Right.
And so the price at the pump has gone up significantly here, but not nearly as much as it has in, say, the United Kingdom. And we should care about it because energy goes into everything we do. We can't get food on the shelves without energy. We can't light up, our houses at night without energy. All the things that we expect to just happen in a modern society depend upon energy. And when that energy becomes more scarce, the price goes up, and that price will then be filtered through the rest of the economy. So
Absolutely.
we also need to be worried about it because of inflation.
Yeah, I heard someone talking about it yesterday on one of the talk shows. It's no longer an input. It's more of a position of leverage. So that certainly helps, the fact that we have increased our energy supply. But let's kind of moving along with that, and that's setting that up as a backdrop, right? So where's the biggest disconnect people have right now between what's actually happening and what they think is happening?
I think the biggest disconnect is that I think people think that the economy and the stock market are much worse than they actually are, especially in the U.S.
I agree.
We got jobless claims or unemployment claims today,
Yep.
and they were 210,000 unemployment claims, and the
Yep.
4-week moving average has been declining, and the continuing unemployment claims, which is something that we watch very, very closely, is now at a significantly, lower level than it was, say, 18 to 24 months ago. And it's been there. Uh, the job market is very strong in the United States. And also, with all this turmoil, our stock market is down 5 or 6% since the all-time highs. I think that the U.S. economy, because of the energy discussion that we just had, because of the technology revolution that
Mhm.
is really happening here and almost nowhere else, and just the fact that we are a strong, resilient economy. We're in a really good shape here, and I think the other thing is that analysts on Wall Street are not decreasing their earnings expectations for
Right.
this year and next year. They're revising their earnings expectations up.
I think that's amazing. And that's exactly, I think, when we think about opportunities, I mean, for people that, like, you've made some recent trades, you've done some things just literally in the past 48 hours, and all great moves, in my opinion, for not because of what we're trying to chase returns today. There's still going to be good long-term moves 3 to 5 years from now. But there are definite opportunities that we see. So what are some of those opportunities that you see? Well, for example, everybody's asking about energy and moves we made. Let's explain why you think energy stocks are a good stock to own, even though they've had a good return in the short term.
Energy stocks, especially oil stocks, tend to follow the commodity price.
Mm-hmm.
And the commodity price, in our opinion, is probably going to be at a level, even if the war was over today and things got back to normal, that oil prices are likely to be 20% higher than they
Right.
were before the war started. Just because it's going to take a lot more time to get all of the resources back online. Now, that's if the
Right.
war ended today. You also have to, because we think in terms of probabilities, right? We're always thinking not in terms of, oh, here's what we think is going to happen. We're going to put all of our chips into that particular outcome. We're also thinking about the probability that this war becomes an extended war, or that the Iranians decide that, yes, they're going to exert significant military influence over the Strait of Hormuz for a long time. That's going to increase price of energy. And there's no
Of
way to
course.
build a pipeline very quickly to go the other direction. And they've even said that they might try to close the strait between the entrance to the Indian Ocean and the Red Sea
Mm-hmm.
with the Houthis down there through their proxies. So this could be a sustained thing as well, and I think that will
Right.
put upward pressure on oil. So even if the conflict is resolved quickly, or if the conflict goes on for a long time, in both of those scenarios, I think oil is sustainably higher in terms of price.
Right.
It's not an issue of supply. Like, there's plenty of oil in the ground, and our
Right.
ability to get at it is incredibly strong because of technology improvements in the last 20 years. It's just a matter of, can that supply actually get to the market?
Right.
And
Exactly.
so that's the big issue.
I
Um,
agree.
and so from that perspective, we've increased our allocations to energy. Now we have investment guidelines internally as well that prevent us from putting again all of our eggs in one
Right.
basket.
I think it's a natural discussion now since you brought up allocation. But let's talk about, where do people need to be allocating capital today?
I think they should continue to be allocating capital very broadly, right? There are still a number of different places that have tremendous value
Mm-hmm.
across the different sectors of the S&P 500,
Right.
and those sectors globally too, right? Industrials related to AI are still going to be strong. Semiconductors are going to be strong. Semiconductor equipment manufacturers, um, you know, the consumer in the U.S. is still strong, and we think with the tax refunds that are coming from the One Big Beautiful Bill, some of that will certainly be spent on higher gasoline prices, but not all of it. And so we think that the consumer is going to continue to be strong, that there's some consumer staples and consumer discretionaries. I think there's plenty of opportunity. And a boss of mine once said the best time to buy stocks is when you have cash. And so if we have had a 5 or 6% pullback, the same stocks that we liked when the S&P 500 was 5 or 6% higher are now on discount. And so we probably want to take a look at adding to those positions.
And that also, it's maximizing return, but also controlling the risk in the portfolio is important. And I think what I just heard you say is, you don't change your strategy as far as like what you're thinking long term, and we let you control how we're doing that in the short term with the allocation. Which you're doing a great job. You're still continuing to outperform the index, which is fantastic. All right, Gary. So when we talk about built to last, what does it actually mean in today's environment?
I think there's 3 things that being built to last in today's environment are really involved with. The first is, I think you have to be tech forward. The AI revolution is something that is real. The benefits from productivity with artificial intelligence are things that we're experiencing in our own business today. It's not just, we've heard that other people are doing this. We've gone out and gotten a subscription to Anthropic Claude and have been designing processes in-house that improve our day-to-day productivity. Both identifying solutions for clients and building out client proposals, and also just internal policies and procedures. We're not using them to buy securities or make trades or decisions in client portfolios. That's still us. But I think if your company is not thinking about and implementing artificial intelligence in getting more productive, that's something you need to be thinking about. The second thing is, I think you need to think about your capital structure. If banks have made too many bad loans, it doesn't matter sometimes how great your company is doing, that you may still find that it's hard to get capital, that it's hard to refinance debt. So I would be thinking about your capital structure and being proactive about it. There's going to be
You're not saying cash is king right now, are you?
Well, that's my final
I'm
point,
sorry.
which is that
Okay.
I think having more cash is not a bad place to be as a business owner today. And one, it's for safety, right? The ability to, if the bank decides that they don't want to give you favorable terms, the ability to, to maybe pay off some debt in order to get those favorable terms. And secondly, cash provides a lot of optionality for you to do things, to make investments in your business, to buy other competitors, and I think
opportunity.
that opportunity cost, of having cash just sitting around, you never know when the next great thing to expand your business or to take advantage of somebody else's stress is going to come along, and having cash enables you to be in the catbird seat.
Absolutely agree with that. Gary, we could talk all day, but to move this along, I want to close this out with 3 significant questions. We're going to start making this a regular part of our segment. And the first thing is, what's the one thing that matters most right now?
Right now, the thing that matters the most is the duration of the war in the Middle East. The longer that goes on, the more things are likely to break in the global economy, and dependencies that we didn't know exist start popping up and impacting investment portfolios in ways that we can't imagine today.
Let's go out 6 months from that time. What are you watching over the next 6 or even 12 months that you think we need to understand, and be specific?
I'm watching default rates. Default rates for student loans, default rates for credit cards, default rates for auto loans, default rates for company debt. That's what I'm watching. If the consumer gets really hurt by high gasoline prices and inflation, And if too many bad loans have been made where it starts to impair bank balance sheets, that's something that I'm watching that could derail sort of the Goldilocks scenario that we're all hoping for.
Lastly, right now, what's the one mistake investors should try to avoid?
One-way trades. Like we talked about with,
Yes.
we think that there's an issue, it could be 3 months, it could be 6 months, it could be a year. I think
Right.
making one-way bets and not considering investing in a probabilistic framework, I think that's a crucial thing. We don't want to do a thing where the outcome is 1 or 0. Binary outcomes are really, really hard. 1, to get right, and 2, to get right consecutively over and over again. But if you build a framework, an investment framework that has investment guidelines in it, that has a probabilistic, framework for identifying opportunities and risks and how those will interplay in your portfolio, you have a much better chance of success.
Then it's built to last.
Indeed. You've taken away some of that fragility.
There you go. Well, Gary, appreciate you being here as always. And for those of you out there, thanks for spending time with us today on Built to Last. If today's conversation helped bring clarity to your thinking around wealth, work, or life, that's exactly why we do this. Till next time, stay focused on building something that truly lasts.
This podcast is produced by Concord Wealth Partners, LLC, an investment advisor registered with the Securities and Exchange Commission. Registration does not imply a certain level of skill or training. The information presented is for educational and informational purposes only and should not be construed as personalized investment, financial, tax, or legal advice. Nothing discussed should be considered a solicitation or offer to buy or sell any security or investment product. All investing involves risk, including the potential loss of principal. Past performance is not a guarantee of future results. Individual results will vary based on personal financial circumstances, risk tolerance, and other factors. Concord Wealth Partners does not provide tax or accounting services. Tax and accounting services are offered through Concord Business and Tax Advisory, an affiliated CPA firm. For more information about Concord Wealth Partners, including our Form ADV Part 2A and Form CRS, please visit concordwealthpartners.com or contact us at 800-838-4370.